Crypto investing strategy. Buy the dips. Buying the dip. A basic investment strategy can be phrased as buy the dips. This doesn't mean go all in while an asset's price is going down. It means average in as it goes down and or buy after it settles. Further, this strategy should mainly be used in a bull market or a stagnant market. As a bear market that is seeing prices decline over a longer period of time, such as weeks, is pretty much itself one giant dip that has not yet stopped dipping. With that said, to buy the dips, one would do either one or more of the following. Buy incrementally as the price goes down, creating an average position and aiming to buy more as the price decreases further. Wait until the price settles and perhaps even shows signs of recovering and buy at that point. Set buy orders at lower prices than the current price and let them fill. Setting buys just before historic support levels, large buy walls, and psychological levels is an especially good strategy, as prices tend to do at least a quick bounce off these levels. This is a better tactic than waiting until prices are high and then buying when everyone else is buying the dips. FOMO, fear of missing out, buying at the top is the main point of this page. Point being, buying the dips refers to aiming to buy low and potentially to sell high, and is better than buying high and then exposing yourself to pressure to sell low. We can buy the big dips or buy when the price has gone well below the average, or we can buy the little dips or buy when the price comes down from whatever it was last. At its simplest, this strategy involves buying when the price is lower than its top market price. At its most complex, it involves studying charts, paying attention to short-term and long-term moving averages on different time scales, identifying historical support levels, and ladder buying. Whatever your level of skill is, your goal is to buy low and sell high. In crypto, we see many little dips, and then every few weeks or months we tend to see very big dips we might call corrections or crashes. Buying either little dips or big dips can make sense to buy depending on your investing strategy. If you are range trading, then little dips are great to buy. If you are a long-term investor, then the bigger dips can be rewarding for building a long position. But of course, you have to be careful about how and what time you buy. The bottom line here being, there is more than one way to buy the dips with crypto or any other asset. However, all versions of the strategy aim to buy at low prices rather than high ones. This means one has to use a little counterintuitive logic and fight off some emotions. Specifically, one must put aside the fear that comes when everyone is selling during a correction. Put aside the impulse to buy high when it seems everyone is buying. This strategy isn't guaranteed to be successful, but it is a smart and simple investing strategy that doesn't take much skill or technical know-how to implement. Meanwhile, if you want to add technical aspects, you can, as noted, look at moving averages, support levels, and volume to get a sense of how low a price might go and get a good sense of when recovery is likely. With the technicals added in, buying the dips can become a pretty solid strategy with a high success rate. Without them, it is still generally better than FOMO buying the topic or panic selling in a stagnant or bull market when the price of bulls pulls back, as it will pull back. Crypto, remember, is volatile. The basic strategy is what it says it is. It's a simple concept with few variations. It isn't always easy to make it work, as no one can see the future, but it does help increase your odds of either getting the best price over time by dollar cost averaging or buying low and selling high. The bottom line being simply buying the dips is a better strategy than buy when everyone is manic and the price is going up in a FOMO-induced panic. When you want to avoid buying at the top and being a bag holder, or in crypto term hodler. Understand why the dip happened. Did the dip occur due to some rumor that will likely have a temporary impact? Was the crypto overbought and now it needs some time to cool off? Did it just fail an all-time high twice and now we are likely headed for a longer-term correction? If you have this answer, then you can better gauge if you should be buying the dip. You'll want to use an exchange like GDAX to do this. Buying any other way is an option, but great deals can be hard to manage without being able to trade quickly. Be super careful with market orders when the price is flying all over the place. If the market is too chaotic, some pretty gnarly slippage can occur. This is one reason to have limit orders already placed around supports in anticipation of the dip. One good strategy is to wait until the price starts going back up to buy and then wait until it starts coming back down to sell. The only problem with this is that if you use market orders, fees can eat into your gains. If you are buying BTC, which is Bitcoin, at $5,000 and selling at $5,100, you don't have much wiggle room for fees. Limit orders can help you reduce fees. If you can figure it out, use MACD, the divergence and convergence of moving averages, to help you understand if we are in a bull or bear market and to help you understand why the price just dipped or shot up. Other indicators are very useful, but MACD is particularly useful for the tactic being discussed. Another good strategy is to average into a dip, increasing your buys as the price goes lower. This can help you to build a long position or to make a quick buck when the price and volume pick back up. A good strategy is to look at what the price has done over 1 hour, 24 hours, 1 week, 1 month, 3 months, 6 months, etc., and set limit orders just under highs and lows. For assets that are somewhat stagnant, this can net you solid buying and selling opportunities in the short term. This strategy essentially mimics Fibonacci retracement levels, but requires none of the technical knowledge. Set stops as needed. We always want to make the right moves, but no one is right all the time. If you need to, be ready to take a loss with a stop. Long downtrends in bear markets can last weeks or months in crypto. Meanwhile, dips in a bull or stagnant market can last hours or days. The trick is understanding what market we are in. In a long-term bear market, you want to move and buy slowly, and in a short-term dip, you want to act quicker. If you don't know which type of market we are in, slowly creating a position and planning for the worst is far more conservative, assuming the asset is going to zero, and making sure you have enough cash on hand to buy all the way to zero is about as conservative as it gets. The image below shows daily candles on a 6-month BTC chart. When the short-term 12-day exponential moving average crossed under the longer-term 26-day in January 2018, it pretty clearly marked a longer-term bear market, a true correction, not just a dip. You can see that buying the dip in this time was not ideal. Not the worst move, perhaps long-term, just not ideal. That is the only sort of market in which you want to avoid buying the little dips and instead want to buy when the price starts recovering. As a long-term investor, a short-term investor can play any market if they are nimble enough. Here's an extra tip. In cases where the price of a coin or another asset is plunging slowly towards its doom, buying the bottom of a dip can be hard if not impossible to pull off. In cases like this, you more so end up dollar cost averaging down the side of the mountain. Watching any asset lose value is stressful, but there is a lot of precedent for this paying off in cryptocurrency when we are talking about buying the dips on top coins like Bitcoin, Ethereum, and Ripple. No plan is foolproof, but the logic here is this. It is better to miss time buys at the bottom than to miss time buys at the top. Thus, buy the dips.